Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. I'm Brian Fernandez, and with me this afternoon, it's Thursday, the 5th of January, and David Kuo, founder of the Smart Investor Singapore, is coming to us out of the UK. David, welcome to the show.
You're welcome, Brian. So it's Selamat Tengah Hari where you are, and it's definitely Selamat Pagi where I am, Brian. It's 5 a.m. in the morning here.
And what sort of temperatures are we looking at, David, right now?
It's actually getting better. It's around sort of 10 degrees over here, so not quite as cold as when I first arrived, but 10 degrees is still pretty cold.
Yeah, for people like us who love the tropics, I think 10 degrees is still very cold. But I'm going to come back to you after we take a look at the numbers. We'll start with crypto markets first. Bitcoin is at 16,836. It's down 0.15%. Ethereum is at 1,253. It's down 0.2. Sorry, it's up 0.28%. Now, looking across the regional equity markets, we start with Singapore. The Straits Times Index is up 1.5%. KLCI is up 0.43%. Shanghai is up 0.82%. The ASX All Ordinaries is up 0.18%. The Nikkei is up 0.4%. The Hang Seng is up 1.29%. And rounding up the numbers, we've got the Kospi, which is up 0.39%. A very unusual David Kuo guest appearance because it's a sea of green instead of a sea of red. Tell us why, David.
Well, only some of them are marginally in the green. I mean, the rest of them, well, apart from Hong Kong, I think I would say they're just kind of treading water. Hong Kong's a bit of an outlier because I think in the case of Hong Kong, people are probably a little bit more euphoric about what is going on in China, and they are hoping that, first of all, the property developers will do well. And secondly, there was some good news about Ant Financials going on. There seems to be a likelihood that Ant Financials may finally be able to sort of get its IPO. So Jack Ma his dream will finally come true. And I think that points to another problem as far as I'm concerned, which is that maybe, just maybe, the banks in China are not as healthy as some people would like to think. And maybe they do need a company like Ant Financials, which can garner the money from consumers and use that to try and somehow stimulate the Chinese economy into some kind of growth. Because I have this feeling that the Chinese banks are not really as healthy as some people would like us to believe, Brian.
And that's an interesting hypothesis that's always been an undercurrent among foreign analysts. Now, David, but the big news overnight is the Federal Reserve's commitment to higher interest rates and tackling inflation. Now, one of those what's the story? What's your view on it, and what are the implications for investors?
Well, I think there are two takes from that, Brian. I mean, the first one is when you have a look at the American stock market yesterday, the S&P, the Dow Jones Industrial, and also NASDAQ were all higher yesterday, despite what the Federal Reserve had said. So either those people didn't believe what the Fed was saying, or they can't read and they don't really understand what the Fed was saying. But for me, it's actually quite clear. The Federal Reserve is going to carry on increasing interest rates and not only increasing interest rates, but they're not going to be cutting interest rates at all in 2023. None of the members of the rate setting committee said they were going to cut interest rates. So where these analysts come out and sort of say that there is a likelihood that the Fed will pivot, the Fed will somehow cut interest rates, I don't know where that story is coming from, because Jay Powell was very clear. He said that he is not going to be doing anything with interest rates apart from raising them until he sees some sign that inflation is going to be heading towards his 2%. And right now there is a gulf between where inflation is and the 2% target that he's aiming for. So I think people can forget totally about any kind of possibility of rate cuts in 2023, Brian.
Okay, so which brings the broader question around the global economy and whether or not the US economy and the global economy is heading for a hard landing or a soft landing, because the numbers just out overnight at Salesforce and at Amazon tell us a different story. They're preparing for a downturn.
Well, they are preparing for a downturn. In the case of Salesforce, they're going to be cutting 10% of its workforce. So 700 jobs are going to go at Salesforce. And then over at Amazon, probably around just under 1% of its workforce It employs about 1.5 million people. So they'd be cutting 18,000 jobs at Amazon. So I guess these two companies are preparing for a economic downturn, or the possibility that sales are not going to be as strong as some people had been expecting. And in the case of Amazon, let's not forget that Amazon was around during the dot-com bubble, so it knows how to handle these kind of situations. And what it did was to employ a lot more people than it really required just before Christmas. And then now it's saying that it really doesn't need these people. So it's going to be axing 18,000 jobs. It's really terrible for these workers to suddenly be handed notices and be told that they don't need to come into work anymore. But as far as the Fed is concerned, that is probably what it really wants to see. It wants to see the labor market loosening up a little, because at the moment the labor market is still fairly tight, which is why a lot of the workers are able to ask for higher salaries. And the Fed doesn't really want that, because it knows that as soon as workers start asking for higher salaries, that is going to get baked into the cost of the company, and then the company has to pass that cost on to people like you and me, consumers. And when that happens, then there is no end to inflation. So maybe, the Federal Reserve quietly will be saying, oh, thank goodness, something is finally happening as far as the industrial world is concerned.
Now, David, we're in January the 5th, early days, start of the year. Markets have been performing, markets had a terrible year in 2022. But there's also the question of the January effect. Tell us about what your thoughts are, and how that will set the stage for 2023.
Well, it's an old stock market axiom that sort of dates back long before I was even born, Brian. And data from 1926 onwards seem to suggest that as January goes, so too does the rest of the year. So a lot of people, particularly those people in the financial sector, will be hoping that January ends on a high note, which then could portend the rest of the year being particularly good. But there's a couple of caveats there. The first one is that since 1926, the January effect only worked 70% of the time. So it means that 30% of the time it didn't work. And even though January either did particularly well or didn't do very well, it didn't portend what was going to be happening for the rest of the year. So people need to forget, something about these calendar effects. What happens in one particular month does not tell you what is going to happen for the rest of the year. And in particular, I think with regards to what is going on at the moment, Brian, is that we've never seen anything like this ever before. We've never had a pandemic that has disrupted the world. We have not seen two superpowers out there fighting with each other in terms of trade. We haven't seen central banks increasing interest rates, even in the face of an economic downturn. So people need to forget totally about the January effect, and instead try and focus on stock that you think will do well in 2023. And if you do that, then I don't think you'll go too far wrong. My three favorite sectors at the moment are the banking sector, because as interest rates go up, banks do well. The second one, of course, is the insurance sector, because insurance companies buy a lot of bonds. And what they will be able to do now is that those bonds that weren't yielding a great deal previously, when they mature, they'll be able to reinvest that money back into new bonds at a higher yield. So I think insurance companies will do well. And thirdly, consumer staples, because you and I, Brian, still need to eat.
On that note, David, thank you very much for your sagely advice. Thanks for your insights.
Thank you.
Now, we've been speaking to David Kuo, founder of the Smart Investor out of Singapore, on BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.